Equity allocation can make or break a startup. It's a critical decision that impacts founders, employees, and investors alike. This video will guide you through the process of allocating shares in your startup, helping you avoid common pitfalls and set your company up for success. When a startup incorporates, it typically authorizes 10 million shares of common stock. This large number allows for easy division and distribution among stakeholders. But how do you decide who gets what? The allocation of equity depends on various factors, including roles, expertise, risk, and contributions. A standard equity distribution often looks like this: 50 to 70% for founders, 20 to 30% for investors, and 10 to 20% for the option pool. Let's focus on founder equity first. Determining how to split equity among co-founders is crucial and should be based on each person's long-term value to the company. Consider factors such as the idea, commitment and risk, business plan development, domain expertise, and responsibilities. Avoid the temptation to split equity equally without proper consideration, as this can lead to future conflicts. Startups typically use three main types of equity: common stock, preferred stock, and restricted stock units. Common stock is usually issued to founders and employees, while preferred stock is often reserved for investors. Restricted stock units are commonly granted to employees and are subject to vesting schedules. Speaking of vesting schedules, these are time-based provisions that determine when individuals can exercise their stock options. A typical arrangement includes a 4-year vesting schedule with a 1-year cliff. This means that if someone leaves before the first year, they forfeit all equity. Vesting schedules help ensure long-term commitment from key personnel. Tax considerations play a significant role in equity allocation. Founders and early employees should be aware of the Section 83B election, which allows them to pay taxes on stock ownership upfront, potentially reducing long-term tax liabilities. It's crucial to consult with a tax professional to navigate these complexities. When it comes to dividing equity, follow these steps. First, divide equity within the organization among founders, investors, and the option pool. Next, allocate equity among co-founders, then determine the amount for investors. After that, divide the option pool among the board of directors, advisors, and employees. Finally, create a vesting schedule. For early-stage startups, convertible notes and simple agreements for future equity, or SAFEs, are common investment structures. These allow companies to secure funding without immediate valuation concerns, but will impact future equity distribution. Don't forget to plan for potential exit strategies. Whether it's an acquisition, IPO, or merger, your equity allocation should align with these future scenarios. Consider how vesting schedules and ownership distribution might affect these events. Proper equity allocation is a balancing act that requires careful consideration and planning. By understanding these key concepts and best practices, you can create a fair and motivating equity structure that sets your startup on the path to success. Remember, while these guidelines provide a solid foundation, every startup is unique. Don't hesitate to seek professional advice to tailor your equity allocation to your specific circumstances.